Stanford University.
So I'm just going to do a quick intro of Chris. So I thought it would be really relevant to start out with, I was reading this Fortune article about him, and the first paragraph says, Chris Douvos is not a celebrity, but among limited partners in venture capital funds, he's about as close as one gets. This is Fortune. The article then goes on to talk about his red t-shirts, his quick wit on conference panels, and his quirky blog, which seems to be the only LP pen site around. So really excited to have Chris at our class today. He's a managing director at VIA, which stands for Venture Investment Associates. So they've made investments in venture capital funds such as First Round Capital, Data Collective, and True Ventures, and the total capital under management is $1 billion. He was previously at a fund called TIFF, T-I-F-F, which stands for the Investment Fund for Foundations. So he represented a number of venture capital advisory boards through that, and also was responsible for over $1 billion in capital commitments. Before that, he was on the endowment team at Princeton University, unfortunately not Stanford, and he's also the author of the one and only blog for LPs, which is called the superlp.com. So thank you, Chris.
Thank you. So, it's actually pretty hilarious because I was leaving the house today and my daughter saw me and she's like, Dad, you're teaching a class, you're dressed really badly. And I looked up and down and I said, well, whatever, when in Rome, here we're gonna hang out amongst the students. But then I started thinking about it and I'm like, holy smokes, I'm wearing some socks from Beta Brand, which is one of our portfolio companies. I'm wearing a Data Collective t-shirt, I'm wearing a General Catalyst fleece, all these things. I have a first round bag. I'm like a walking advertisement. And it reminded me, and I've got my laptop here with all my stickers, and stickers are like tattoos for tech geeks. And it reminded me of this blog post I wrote a long time ago, which is actually, it's the most hit blog post that I've written. It's called In the Time of Chicken and Brulee. And it's annual meeting advice for general partners. And we LPs, I probably go to 40 annual meetings a year, and they range from really interactive ones where you have some of our tech, super early stage tech heavy firms that'll do science fairs where you're sitting around and you've got pneumatic robots walking around and doing interesting stuff, to these kind of buyout shops that have 400 people in attendance. They have teleprompters and people are standing there doing the Bill Clinton kind of non-aggressive thumb punch. And it's just endlessly boring. So I decided to write this blog post that has gotten, I wrote it 6-7 years ago, and it got so much traction. But at the end of it, I wrote, we're always getting these gifties, and by God, I have more than enough. The homeless of Palo Alto are very well clothed in fleeces from third quartile partners. And I've got just too much fleece. So haven't we killed enough herds of polypropylene sheep to get these fleeces? And I said, from now on, Titleist V1s, right? That's what we need, golf balls. And literally the next week I was at First Round and hanging out with Josh Koppelman, and Josh says, we've got our advisory board coming up, and what do you want? I go, it's funny, I don't have any good fleece. And he goes, oh, you hypocrite. You're like, well, I said good fleece, not this junky fleece that I get from everybody. So anyhow, every LP I know has a closet full of gear. I have, boxes and boxes of stuff. And that's, when I was at Princeton, our head of hedge funds always, I'd come back from these conferences with, samples from portfolio companies and fleece from the managers. And Peter Stein, who went on to be CIO at Chicago, it would just sit there and go, man, I'm in the wrong asset class. And so I've always gotten a kick out of that. But I have to say, in a post, Sarbanes-Oxley and, kind of, compliance world, the swag has gotten a lot worse in the 15 years I've been doing this. Anyhow, on a more serious note, we LPs are kind of an odd duck. I actually figure there are only probably a couple of hundred people in the world who do the voodoo that I do, and what's interesting about that is that we're actually, I think, a dying breed. And in fact, we'll talk a little bit more about this in a minute. But there's this kind of explosion in the ranks of private equity LPs in the post-Swensen book publishing era. And then we've been kind of contracting slowly ever since. I feel like one of these kind of spotted lizards that they had to reroute a hole on the Stanford golf course to help save. We're at some point a dying breed. But at the same time, the profession, as it were, continues to kind of evolve and innovate. So, what is it that we do? Because my mom continues to think that I'm a stockbroker. She has no idea what it is. She's like, what should I buy? Should I buy GE or Apple? I said, I have no idea. I don't look at any companies that have, I used to say that have valuations over $1 billion, but today $1 billion private company is commonplace. The world has changed. But this is a slide I put together to kind of help some GPs actually. Back in 2001, the Young Venture Capitalists Association of Philadelphia asked me to talk about what I do. So I came up with this list, and we had a nice kind of round table, and I said, we're high throughput screeners. I look at 400 funds a year, and I have to kind of make snap judgments. Is this someplace where I'm going to vector my scarce time? In a portfolio of 30 funds, when I'm kind of constantly being bombarded, how does something new fit? You have to be a professional skeptic. Everybody is a fantastic salesman, and you can sit there all day long and get pitches from people, and your head will spin. Every opportunity is as exciting and enticing as the last. I say really the essence of my job is being an investigative journalist, right? I spend a lot of my time trying to decipher what it is that GPs are telling me and how it is that they do the voodoo that they do. Panhandler, part of my job back in those days was to try to get access, even for kind of fair Princeton, into the top funds. We weren't investors in groups like K. Peter Benchmark, and we would kind of go on bended knee up and down Sand Hill Road kind of begging. Self-appointed pundit, that's one that's kind of unique to me. I like to jibber jabber because I actually think that the more transparent I can make my job, the better it is for my interactions with GPs, because one of my themes is intimacy, right? I want to be intimate with my GPs. I want partnership with a capital P. And then the last one is kind of counselor and teacher. Part of what we LPs do is, we're counselors to our GPs. We help them understand how to kind of present what they do in a way that's relevant to us. And then we teach, in turn, our investment committees about private equity and venture capital and the things that are interesting. So that was interesting, that was fun, I thought that was my job. And then 2008 came, and all of a sudden I'd been at Princeton, and Princeton, was so levered. It was crazy how overexposed they were to private equity. For reference, our target for private equity in terms of value was 16%. And there's a rule of thumb that you have to commit $2 for every dollar of value because of the drawdown structure of private equity. And so, if our target was, actually, in fairness, our target for private equity plus real assets was 27%. So for 27% value exposure, you try to target 54% kind of value plus undrawn. Princeton was at 80%. And a lot of that was undrawn, and all of a sudden we had this huge liquidity crisis, and everybody's looking around saying, holy smokes, we have so much undrawn capital, and if our managers start calling tomorrow and drawing it when our endowment is down 40%, we're gonna have to use the public portfolio as an ATM machine for the rest of the portfolio, and we're gonna be selling when the markets are down, which is what you don't wanna be doing. So it was a tricky time. So all of a sudden now we're whipping boys and apologists, in all these endowments, you walk into these committee meetings and they're like, you told us to do this wacky private equity stuff, and now our university is on the verge of no longer being a going concern because we're so levered. We're going to lose our AAA credit rating. That wasn't the case at Princeton, but there was one prominent university where we'd all want to send our kids, where they were writing these checks out, and literally there were people were asking the question, would these guys have the money to cover? Referees, we'd be in these food fights between GPs and LPs and internally in our institutions. Therapists, that was one that I actually loved. We'd have these GPs come to us and basically say, I've been investing all my life and it's never been this hard, and this institution is beating up on me, and woe is me. And you'd put your arm around them and you say, it's going to be okay. Markets go up and markets go down. And there's a lot of really interesting stuff, and kind of two of my themes. One I mentioned is intimacy. Another one is authenticity, right? We're in this world where there's so much veneer, and so I spent a lot of time really getting to know people and really kind of soothing them, and they were probably soothing me at the same time. I just was too dumb to realize it. Accountant, all of a sudden there's all this crazy fair value stuff that we've got to be, understand. Public market investor, all these people had public positions, public positions in private, equity, where we're watching the markets kind of on a momentary basis. And then bargain hunter / street peddler in a tight liquidity environment, all of a sudden we're looking what can we sell? Or wow, Harvard famously would irrationally sell their stakes in these private equity funds at like 50 cents on a dollar. So we, at TIFF, we were snapping things like that up. So it's a really bizarre kind of change of kind of the essence of my job. And then here I am, like, kind of another 6 years on, kind of 15 years into my career as an LP, and my job has changed yet again because we're kind of in these go-go years. And all of a sudden, I feel like Tobey Maguire, the Tobey Maguire, Nick Carraway character in The Great Gatsby, right? And if you guys have read The Great Gatsby, Nick Carraway is this like outsider who's like all of a sudden kind of privy to these parties. And I've always loved, ever since the first time I read Gatsby, I've always identified with Carraway. I was a scholarship kid at Yale. I was a son of a cab driver. And here I am, I'm like looking around and I'm surrounded by this, these amazingly talented and in a lot of cases wealthy, certainly far wealthier than I was people. So I've always felt like that, and I feel like that again because I love this quote, because this to me is the essence of Silicon Valley today. The tempo of the city had changed sharply. The uncertainties of 1920 were drowned in a steady golden roar, and many of our friends had grown wealthy. But the restlessness of Palo Alto in 2015 approached hysteria. The parties were bigger, the shows were broader, the buildings were taller, the morals were looser. I love that. Restlessness approached hysteria. That's what it feels like when you go out to portfolio companies. I was at an incubator yesterday, and you got these people kind of 6 months away from final exams with companies that are worth hundreds of millions of dollars, and they're driving Ferraris. It's unbelievable, and it's a really interesting question that's going to kind of come up again. So that's kind of what it is to be an LP today. We're kind of at the party, but not part of the party. So a little bit more about, and I'll kind of breeze through this. A little bit more about kind of why do institutions, because this is something that's lost. Like you go up and down Sand Hill Road, and people think it's like or now I guess South Park is the new Sand Hill Road. People think there's this like endless spigot of money out there. But it all comes from people who actually have to make choices and have to consider opportunity costs. So I've always said, private equity is enhanced equity, right? It's, your bogey is not being top quartile. I call this the tyranny of the relativists. What's that line from The Usual Suspects? The greatest trick the devil ever pulled was convincing the world he didn't exist, right? The greatest trick private equity's ever pulled was convincing people that top quartile is victory, right? And we'll talk about that a little bit more too. But no, when you're investing in private equity, the opportunity cost of equity capital is your bogey. And so if you're successful in private equity by being top quartile, but you're lagging the public markets, you're wasting everybody's time. And institutions are acutely aware of that. And so, as those kind of dials get turned and the spigots get loosened and opened, that impacts the flow of capital to these zip codes. And so institutions actually ask two questions: where do we play? So among these assets where we want to, kind of, spit out our, kind of vector our capital, where do we want to direct that? And then once we decide where to direct it, how do we play in those areas? And I love this line. When I took Swensen's class as an undergraduate, he said to us, investing is about optimizing discomfort. But what became apparent to me was that different investors have different comfort envelopes, right? And that's actually a really interesting insight that we'll talk about in a second. I should pause here and just say I prefer to be interactive. So if anybody has a question,
When you say top quartile, you mean among top quartiles among VCs, or?
So yes is the short answer. So the current benchmark is that whether it's Cambridge Associates or Venture Economics will take all of the funds in a given vintage year to kind of give them kind of time definition and then rank them and then kind of break them into quartiles. And somewhere along the line being top quartile is defined as victory. Now what's interesting about that is in a lot of years, Cambridge only tracks like 25 funds or 30 funds. They don't have a holistic. So, N is not large enough to actually get a representative, sample. But so does that answer the question?
Yeah, so just to clarify, you're saying that basically because venture tries to convince everyone that top quartile means success, even when all of venture is failing, perhaps that's the disagreement between the two. Right.
So let's see, for like 2003 funds, I think the top quartile breakpoint for venture firms is something like 9%, right? So if you've got a fund that's returned more than that, you're a winner fund. But over that horizon, I think the public markets have returned 11.5%. And so it kind of begs the question. We'll talk a little bit more about the skewness too in a second. But that's a good kind of thoughtful question, and it's something that stresses me out constantly. Anyhow, you guys know this stuff. It's Portfolio Theory 101. This is basically by adding diversification, putting in assets at zig when others zag, you can actually get a free lunch, which is higher risk-adjusted returns. But yet, institutional investors who basically do these optimizers, and for those of you who've taken finance classes where you've done this kind of stuff, asset allocation, you know that these optimizers are subject to the garbage in, garbage out problem. But we ignore that because you pay no attention to that man behind the curtain. Because basically what happens is, people are sitting around, and I remember we used to sit around at Princeton, we used to run the optimizer with inputs that we thought were good, and then we're like, well, the optimizer is spitting out that venture capital should be X% of our portfolio, but that's very uncomfortable, so let's say it should be 11% max, right? And so you've got these interesting kind of issues and constraints that actually start to impact how much those institutions end up putting in private equity and then by extension venture capital. But among these, the greatest is career risk, right? And I love the Brits, right? They really kind of get this investing thing. And I love Jeremy Grantham particularly. Over 90% of the decisions in asset management first take into account the career risk associated with those decisions. So this is why people have gravitated towards looking for top quartile funds, even though there's actually mounting evidence that in venture capital winners don't repeat, which is actually really interesting. There's all these kind of dynamics, which actually makes my job maddening, because if people are saying like, wait a second, you need to be in every Sequoia fund, for example, well, that's great. Actually, their funds tend to repeat, but DFJ, right? DFJ will have a first quartile fund, and then a fourth quartile fund, and then a second quartile fund, and a first quartile fund, and a third quartile fund. And because you don't have winners repeating, it becomes kind of comfortable to seek out brands, which has led to some funky dynamics where people in my seat can actually make a perfectly good living just seeking out the funds that everybody else is going into. And actually, I love, how do I put this screen up? Is there a button here? Okay. So we'll talk a little bit more about this in a second, but I was a consultant once, so I love my 2x2 matrices. And one of the things that they don't really like to teach in business school is that if this is right and this is being wrong about an investment, good decisions often have bad outcomes, right? So good investors tend to have a distribution that's skewed towards right answers. So you have some control over this, but what you really control is whether you go with the crowd or whether you're alone, right? And what's interesting is that so many people in my seat, being an LP is one of the most risk-averse jobs out there, right? It's actually interesting. It's interesting because you guys have seen the movie The Graduate or know about the kind of plastics moment, right? My plastics moment is, I'm sure you guys have read some Michael Porter in class and such. Michael Porter was at my consulting firm when I was a young lad, and I never met him until my very last week, and he and I were in the men's room together, and there's a really funny story about that for another time. But we're washing our hands, and I say, hey, Mike, I'm going off to business school. Do you have any advice? And he goes, well, my students at Harvard, it's 1999. My students at Harvard are all studying, technology and banking and stuff. So he goes, Douvos, you should do railroads. And I go, well, what do you mean? He goes, nobody's doing railroads, and a young kind of charismatic guy like you'll be CEO of Burlington Northern by the time you're 40. And I go, wow, that's kind of crazy. So what did I do? I went to business school and studied technology and investment banking. But then I spent my summer at Morgan Stanley and was miserable as an agent and decided I wanted to be a principal. And I started thinking about what Mike said, and basically what he was saying was that you want to do something where you can kind of stand out. And so that's why I thought, wow, I can be an LP, because my friend Seth Alexander, who's now the CIO at MIT, he was a year behind me at Yale College, and he said, the thing we always say in the Yale Investments office is, may you be blessed with a weak benchmark. And he goes, we like to think that we're the smartest guy in every room that we've been in. And he goes, Douvos, you're relatively smart, not as smart as us, but relatively smart. You should go do this and talk to the Princeton guys. And so I started thinking about this, kind of the essence of being alone, like you want to hit them where they ain't. This is kind of Yogi Berra 101. And then I got to TIFF, and this is where this really crystallized, because David Salem said, I want you to invest heroically. I want the fear of being wrong and alone to not be present in your mind at all. He says so many, and one of his mentors is Jeremy Grantham, he said so many people are motivated by avoiding this box, the wrong and alone box, that they end up taking the right and alone box out of play. Because they don't know when they're gonna be right and they're gonna be wrong, so they just gravitate towards the crowd. And that's what's so dismaying about investing today. So let's talk a little bit more about the conventional wisdom. So again, I keep kind of referring back to Swensen, who's, that reminds me, in New York State, they used to have the death penalty, and they would execute somebody at Sing Sing every Thursday, and Con Ed, the utility, would dim the lights at 9:06, just a little bit. They'd have a little brownout, there was no reason, but people would think that was the power draw up in Ossining, kind of affecting the grid in the city. So I think that lawyers would call that an in terrorem benefit. That just freaked me out. I just got really stressed out. Somebody putting a damp sponge on my head. So anyhow, in venture capital, the granddaddy of them all is David Swensen. This is actually really interesting. This is real insight. You guys are privy to a moment here. It's really interesting because I worked for Andy Golden at Princeton, who trained under Swensen in the earliest days. I don't think there would be an institutional private equity business without David Swensen. Because in 1984, 1985, when Swensen started at Yale, he basically said, we have to be long illiquidity, we have long-term horizons, we can do stuff, we want to own growth, we want to own optionality, all this stuff. We want to have an equity, kind of orientation. And Swensen kind of pioneered, private equity in those days. And I asked Andy, I said, hey, Andy, what was it like to work at Yale in those days? He was there in 88, 89. Was it really hard to find private equity? You guys were out on the bleeding edge. He goes, no, it was actually really easy. I go, I don't know how many people actually know this, right? This is actually really interesting. He goes, it was really easy. I go, what do you mean? It must have been really hard. There's this nascent. He goes, no, we just decided what we wanted. We'd meet every manager in that space, and because there weren't that many, we'd fund half of them. I said, what do you mean about that? He said, we decided we liked middle market, operationally intensive buyouts. We decided we liked early stage venture. When we liked early stage venture, we went out to Sand Hill Road and we met with, this guy Eugene Kleiner. We met with, Pierre Lamont. We met with all these people, and we found the half of the people. And by the way, 3/4 of those decisions were terrible, but there's such an asymmetry to the outcomes, and there's a persistence to the winners that it made our portfolio. I go, holy smokes. And I think about today where there are, I've gotten pitches from 1,200 funds in my life. I'm and there's this actually a whole nother thing about entropic homogeneity, where basically the longer a practice is underway, the more similar everybody looks, right? Baseball batting averages were on average 280 in the year 1900, but the standard deviation was 90 points. Today, the average batting average is around 280, but the standard deviation is 20 points, right? And there's this pennant effect. And Stephen Jay Gould wrote this great thing: in every field of human endeavor, you see this kind of narrowing as best practices spread. So, so Swensen wrote a book and basically said, after he had placed all his chess pieces on the board, he went and he wrote a book. And I always say, I used to go and pitch nonprofits when I was at TIFF, and I'd sit down at this, kind of committee table, and everybody would have a copy of Pioneering Portfolio Management. And I'd sit down and I'd say, and now for a reading from the Book of David. Please turn to page 263, where David basically says, people are asking, what's the average endowment's, allocation to private equity? And I would say 20%. And they'd say, well, why do you know that? And I said, well, that's because what Dave said it should be, and then everybody went out and did it. It's interesting because now Yale's up to 32% in private equity, which is actually pretty robust. But everybody kind of went following Yale. But again, back to this kind of comfort envelope dynamic, Yale has a very accommodative committee that will kind of stick with them through thick and thin. They have a time horizon that's much, much longer than most folks. And so a lot of people who followed, Dave's book was published, the HBS article, case study was in 1995. The book came out in 2000. By 2001, everybody was at 20%. And then everybody's like, holy smokes, what have we done? Because people are so kind of way out of their skis. Anyhow, long story short, this is our asset allocation at Princeton. And I once I noticed VC's way out here. This went in our board book. I actually swiped this from the board book. Don't tell Princeton. Don't tell Pete Wendell, he teaches here. He's a great guy. He was our committee chairman. I swiped this, but what I did one year, is I put like baseball cards here, rare coins here, like, all these like goofy assets, like Beanie Babies were down here, very low expected return, high standard deviation. But I said like, this is like what venture capital is. And in fact, what I used to say is like, hey, we use all these lottery slogans with Ivy League veneer. So we basically talk about optionality, and it's the same thing as saying you got to be in it to win it. So I've always said these two guys are the patron saints of VC. These were the first New York lottery, $5 million winners. Curtis Sharp and Lou Eisenberg, and these guys, like after a while, they were in all these ads. They were like celebrities in New York, and so I always think people say that the patron saint of VC is General Dorio or any of the Art Rock or no, it's these guys, because people like me basically sit here and we say like venture capital is like where the sex and violence in the portfolio is. It's like the dark valley, dark valley slip, where you go and you find all the like really exciting, gritty, like kind of life-changing stuff. And that the numbers actually bear that out, right? This is this again from the Yale report. This is actually interesting. This is the dispersion, again back to the quartiles. The dispersion between the top quartile and the bottom quartile in venture capital is 35%. So basically, being right gave you a 35% better return over a long horizon than being wrong. It's really interesting because that, there's so much interesting about that, but I'm on the clock. But here's the problem. So all these people came in, and this actually is a chart that came out just the other day. So this is, and by the way, it may seem I'm like I'm on a data jaunt, but this is the kind of stuff that stresses me out, right? My job is to return money more than greater than the stock market, particularly adjusting for risk and illiquidity. And then I look at stuff like this and I go, why do I bother? Because this is the median. So this is if you invested in the average fund, the median fund. TVPI is total value to paid in, and DPI is distributed to paid in. So the gray is DPI. Now there's some time bias here because these are young funds. They've still got kind of portfolio companies that are kind of underway. But boy, you have to go back all the way to 1996 to get a fund that's distributed more than 2 times money, where you've doubled your money. And you can actually do that reasonably easily in the stock market with credible managers. And you can actually do that incredibly easy in the buyout world by buying stable cash flowing businesses with moderate leverage. So again, I'm always asking the question like, why do we bother? And again, this is actually an interesting, this is that Yale chart. This is the gap between top and bottom quartile. In some years, being right has an 80% premium to over being wrong. But then I would say, wait a second, there's this weird skewness because the best funds in the 2008 vintage, if you were in first round capital, which is going to be a 25x fund, your track record, you're made, right? But if you are in the top quartile fund, you may actually be negative. And what happens is the skewness will increase what's called the pooled mean. And so it's actually really weird because you have these gaps when there's years of skewness. And this is a kind of an arithmetic point where the pooled mean, so basically if you invested $1 in every fund, was 45% higher than the median fund, right? Now that may not mean anything, but basically what it means is like, if you took out that 1 or 2 funds at the top, none of the arithmetic works for anybody in the industry. And so I would say skewness can drive sadness. A lot of people have invested in okay funds, but have not made any money, right? And it's interesting now because now we're seeing all this money come into venture deals, right? And this is another thing that stresses me out. The red bar is capital that has gone into companies, and the yellow bar is capital that's been raised by VC funds. So it's interesting. We haven't had you have to go back to 2007, right? It should be a closed system. Well, it shouldn't be a closed system, but one would think it's a closed system. VC funds raise money and then back companies, right? Well, that hasn't been the case. That we've had a net. You can see there's in these years there's kind of a buildup, so there's absorption in these years. But all of a sudden there's historically 14% of dollars have come from non-VC funds. In recent years, it's been like 35%. So where's this money coming from? Well, it's coming from hedge funds, strategics, and public market players. And all of a sudden, these folks have a radically different, I'm sitting here and I've got to return 3 times money to my LPs to make it worth their while. But some of these guys, T. Rowe Price says famously, we just need an 11% return. And not only that, they're because they've got so much capital, and there's a whole question about the changing structure of the public markets, which is a whole nother class. Some of these folks have to put money in just to get this emerging growth exposure. So now the funds that I'm investing in, Tiger comes in and they say, well, we want to own this much. We don't care what the valuation is. We don't care how much money we have to put in, but we want all this structuring and all these terms so that when the company goes public, all of a sudden the venture capitalists, the traditional venture capitalists that put money in, they get crammed down. And I look at that, and I've heard horror stories of guys who are in amazing deals who've gotten 2x returns. And you're just wow, that should have been a 50x return, but they got kind of structured out of the deal. So this is all the philosophical stuff. Let me talk a little bit about kind of how I do the voodoo that I do. And I always think of investing as a 4-pillar process. So you need to understand the people. So I just wrote this blog post on Super LP called Tradecraft After Ellen. And the Ellen Powell case, if anything, it showed us how dysfunctional these friggin' partnerships are. And say what you like about that, the specifics of that case, it was a real insight into the distractions that a lot of these funds face. And I need folks, kind of dedicating all their life energy to making returns for me, not to be dealing with some of the challenges that these interpersonal dynamics offer. I would say when we sign up for a venture fund, we're signing up for a partnership that's twice as long as the average American marriage, right? Isn't that weird? And so, I always say marry in haste and repent at leisure, right? And it's doubly kind of interesting because actually, let's put a pin in that for a second. So people, you got to understand the people, you got to understand the strategy. Do they have a resonance, right? I'll say Trevor. Trevor's got some interesting people around the table, and there's an interesting strategy, and there's a nice resonance between the people and the strategy. It's amazing how often, the one example I always use, it's amazing how often I meet these middle managers from Procter & Gamble who all of a sudden want to run a microcap buyout firm. And they say, oh, well, we can bring operational experience and whatnot. Well, no, you had a staff of 30 people for all these years in Cincinnati. What do you know about actually being in the weeds of deploying all these kind of plays in the playbook? So out of the people and strategy falls the portfolio. And that's where I spend most of my time, and we'll talk about that in a moment. And then out of the portfolio falls the performance. And I would say performance is a lagging indicator, not a leading indicator. The problem is if you go to your average pension fund, the place they start is with performance. And I think, again, back to this, the average time to liquidity for a company is 8 years. And so basically your true evaluation horizon is longer than most people's attention spans, and in some cases even longer than people's career arcs, right? And now all of a sudden you've got people using the most rear view mirror kind of metrics to start evaluation of funds. I think it's ass backwards. But the challenge with that is that it's an easy metric. So going back to portfolio, are you cutting me off?
No, I was going to ask, how does the investment process change for first-time funds versus funds that you're reinvesting in, or maybe brand name funds that you're considering of investing in for the first time?
It's a great question, and it's a PhD thesis answer, length and not quality. What I'll say is every investment is a fresh money buy, right? So even when we're re-upping in a fund, I spend a lot of time kind of understanding the portfolio. And for me, it's kind of a continuous continuous evaluation process. So, one sneaky thing I do is instead of having an annual meeting, I take my investors on field trips. So this is kind of part of my tradecraft. So there we are at 3D Robotics. There we are, kind of talking drones with Chris Anderson. There we are at first round in AngelList. So kind of that continual, and again, this goes to kind of the point of intimacy, right? I want to be able to understand my managers, not only through the prism that they're putting forth, but through the prism that the world sees them through, right? So, so I spend a lot of time. So to your question, first-time funds is a really interesting and kind of tricky, area, and I've never had a first-time fund that I've invested in that hasn't disappointed me in some way. And the only hope is that the greatness kind of compensates you in other ways, right? But long story short, the things that get me excited about first-time funds is when entrepreneurs tell me, wow, somebody is doing something really interesting and different, right? And so I think back to when, actually this is an interesting detour that I'll take for a moment. When I was at Princeton, I was convinced we were doing due diligence completely wrong. We were running up and down Sand Hill Road, and we were saying, "Hey, John Doerr, who's good? Hey, Mike Moritz, who's good?" And you're basically getting warmed over conventional wisdom. And I thought, I was a history major in college, right? And that has to be useful for something. And history is the study of primary sources, right? And continuity and change. And I thought, well, our primary sources should be the entrepreneurs, right? After all, they're where the rubber meets the road. So I made this rule for myself. For every hour I spent with a GP when I flew out here, I would spend an hour with an entrepreneur. And back in 03, 04, people were talking to me about stuff like, whoa, you can actually get this thing called an Amazon Web Services account, right? The Elastic Compute Cloud, and all of a sudden, I'm like, what is this? And they're like, that you can start a company with a credit card. I'm like, wow. And so all the stuff that today we take for granted as lean startup was completely new back then. And I'm like, well, who gets this? And they're like, oh, well, Tim O'Reilly gets it, and these two guys in Philly, Josh Koppelman and Howard Morgan. And so I got to know Tim O'Reilly, and that led to an investment in OATV. And I got to know Josh and Howard in what became First Round. And getting to know those guys over the course of a full kind of 2-year time frame where I was kind of keeping an eye on what they were doing was amazing. Now, the challenge is that oftentimes, I prefer to be proactive, but many LPs are reactive, and you get a pitch, you read the deck, and you take a meeting, right? And then you have to decide within, a month, at the outside 2 months, maybe sometimes if you're lucky, 3 to 6 months. And I just get so uncomfortable doing that because there's so much. Unless you're if you're at all a good fiduciary, that's a tough process. And so I look back, Salem kind of charged me with investing heroically, and I felt so heroic, right? Going out and talking to these entrepreneurs and triangulating and finding these random guys in Philadelphia and giving them $2 million and stressing out about it, $2 million out of their $15 million pre-fund. And we got to know each other, and then Josh, and actually I love this slide. This is, another quick story. This is my own little victory lap thing. Josh and I were talking about what is kind of the idea of a postmodern venture firm, and Josh said it's we want to be Napster for venture capital. We want to remove the GP as a rate limiting step, and I said so it's you want to be a Keiretsu, because John Doerr was talking about Keiretsus then, and Josh was like no because that implies cross holdings and it's too businessy, and I go, whoa, you're talking about portfolio as community. And so today, whenever you go in any first round office, they have this sign, and it's no, it's not a portfolio, it's a community. And I'm by the way, I told this story at the first round 10th anniversary dinner, and Rob Hayes speaks up and he goes, all right, Douvos, cool. Will you now tell us about the time that you introduced us to Uber? And well, so Travis and I were sitting at the Creamery now. Clearly a joke, but no, I mean, it was awesome because it was so new and revolutionary, and I'm attracted to, again, this is the, completely being afraid of being wrong and alone. It's a unique, I don't want to kind of toot my own horn because I've been wrong actually probably more than I've been right in number. But boy, it's exciting when you find a nascent team that's onto something interesting. This is just other stuff. Just rounding the corner because I don't want to overstay my welcome. LP-GP dynamics are interesting now because venture capital has more units of ego per dollar of return than any other asset class. And it's amazing to me how quickly the pendulum swings from, LP favorable back to GP favorable, and it never quite swings back. It never quite swings back all the way. It kind of swings and then swings to here and then swings to here and then swings to here and swings. And it's pretty amazing. And I remember, one of the things I learned, Mr. McCants at Greylock, Henry McCants. I call him Mr. McCants the way Derek Jeter calls Joe Torre Mr. Torre. Mr. McCants put his arm around me. We were talking about a term in a document. He says, Douvos, young son, he's this grand old man eventually goes, son, if we ever have to go in the bottom drawer and pull out our documents, we've lost. He says, we should have a partnership with a capital P where we do right by you and you do right by us. And that was so instructive to me. I said, whoa, this is a really cool business. I was like, whoa, this is we're playing a gentle person's game here. And now I find myself constantly going in these bottom drawers, and you find these Gunderson Detmer documents where it's on page 16, in Article 6, Section 4, subfootnote C, if it rains in Palo Alto in April, you have to assign your firstborn to the second youngest partner who's without a child. It's all this stuff. I'm really? Guys, all the time. I'm going in these documents and I'm there's all this junk. So long story short, the pendulum really has swung back, and it's interesting because there's a real haves and have-nots. There are a lot of funds that are getting raised where basically the GPs are dictating terms. And if we look to hedge fund world as an instructor, and people are really pushing terms. If we look to hedge fund world, there are funds in hedge fund world where people are paying 3% fees and 44% carry. And they're still making money, Renaissance Technology is still compounding capital at a 50% IRR. But boy, I'm starting to see, first, everybody, during the last bubble, we saw 30% carry as being the new premium carry. Now it seems like every fund that's getting raised has, if not a 30 carry out of the box, a step up to a 25 and then a 30. It's almost unusual to see a straight 20 carry nowadays. So economics are radically shifting in GP's favors for the funds that are able to the kind of 15 funds that really raise half or 60% of the dollars. The tempo of the landscape is crazy, and it's again a McCantsism. Mr. McCants said to me, when venture capital is working well, capital is extremely expensive and time is very cheap. And the thing that's interesting to me is he said, but when it works, during the bubble, we see time becomes very expensive and capital becomes cheap. And that's what it feels like right now. The landscape feels very carbonated, particularly along those dimensions. And it's interesting because along these lines, kind of tying this stuff together, I just heard about a fund. This shocked me. I heard about this yesterday. But on the one hand, it shocked me, but it didn't shock me because I've seen this 100 times before. It's you see these things on the news sometimes, like somebody who's juggling cats. That's shocking. But no, we've seen so many times before, we're numb to it. Sorry, was that in the movie The Jerk, where the guy's juggling cats? It's anyhow, you get the picture. I heard about this fund that's a very, very kind of well-loved fund among certain people, two very hot ex-entrepreneurs who raised this fund. And they had very good institutional backing, very concentrated. So they 5 of their investors were 80% of their dollars. And my understanding is that they asked one of those investors not to return because that investor was asking questions that were too hard. And I'm thinking, wait a second, this makes no sense whatsoever. And so when people ask me what it's like to be an LP, I think of the Tobey Maguire picture, and I think of that as being an LP today. It's I'm a kid from Brooklyn, so I don't know agricultural metaphors, but I have a friend from Alabama who'd always yells, "It sounds like you LPs are always on the hind teat." And I'm like, yeah, sometimes. I don't even know what that means, but it sounds right. Anyhow, that's about all I have to say about the voodoo that I do. I don't want to get into any more agricultural metaphors because I'll get myself in trouble. But let me stop there and see if there are any questions after that kind of shamble through LP world.
If they can charge it, if the
you know what? We live in a market economy. And so you're absolutely, the question is, and this goes back to the question of kind of true evaluation horizon. So you look, and I'll use a real company, but no fund in particular. So you could say that somebody who's an investor in Fab, you guys know the company Fab, right? Meteoric rise, can falls be meteoric, I guess. You could imagine that a seed investor, so I'll tell you, first round is an investor in Blue Apron, right, which had similar dynamics to Fab, similar dynamics on the upside, right? And I know the impact of the economics of Blue Apron on FRC, not Uber and all that stuff is in the past, but like more recently, stuff that's relatively unproven. And you could go out today and basically, if you were a new fund that invested in Fab, you could raise 2 subsequent funds before people would ask questions. And you could even say, I'm going to push terms because look, I've got 118% IRR based almost exclusively on Fab. So, kind of back to this question of, what is a true valuation horizon, which actually, I said, a lot of people have these kick-ups. I'm actually not against paying people for performance. So a lot of these way the carry kick-ups work, and actually my fund has one, where if after we distribute 2 times committed capital, we actually don't take any carry until we distribute 2 times because that's what we think the minimum return should be. And then after that, we have a 5% carry, right? That's the fund to funds layer. Many other funds, distribute 2x and then go from 20% to 25%, and then after 3x go to 30%. I actually, on a distributed basis, think that's a reasonable term. But to say we're in all these hot companies, and again, it kind of goes back to, I blew it. I totally blew it. It goes back to that slide about, there it is. Where's my mouse? There you go. It goes back to this slide, right? This is actually a really interesting slide. Because by the way, I'll guarantee you, most of the funds that were killing it through here have 30 carries. And this is a median, so the numbers will be skewed. But I'll tell you, Kleiner Perkins has premium terms. I wouldn't give those guys my worst enemy's money, right? Those people. It's amazing to me that people in Dubuque still think KP. Actually, I probably should send. Somebody's probably the distinguished, Eugene Kleiner distinguished professor. So I don't want to. I'll censor myself now. But no, there are a lot of people who had these these dynamics. So I agree. I totally agree with you. If we had perfect information. This is you just stressed me out because this is what stresses me out. No, guys, I love it.
So talking to a lot of folks like you, one thing that amazes me is how sort of monodirectional the interest is on a few metrics that are fairly simple, like calculable in your head.
Like what?
You can calculate them in your head
by
just looking at someone's track record, and I feel like that's too simple a way to make a decision on the goodness or badness of a portfolio, and I wonder what are some other metrics that you consider when you're looking at funds?
So it's an interesting question because you've hit on something that's actually part of the challenge, right? And it goes to this kind of time is expensive challenge, right? Which is people focus on a few metrics because they're kind of easy heuristics that they can kind of extrapolate. And if you're doing this job really well, it's crazy time intensive, right? When I was getting to know First Round, right, Josh had made a bunch of angel investments, and I went and I sat, I remember they had this company called Video Egg, which is now part of Say Media. And the Matt Sanchez, the CEO, was on the cover of the alumni magazine, and August Capital, Mavron out of Seattle, and First Round were the investors. And I went to hang out with those guys at their offices south of Market, and I brought a case of beer, and we all got smashed over the course of a Friday afternoon. But I learned so much not only about their business, because entrepreneurs love talking about their business, and no LPs ever show up at entrepreneurs' doors, especially with cases of beer on Friday afternoons. But I spent a half day learning about those guys' business, learning about why August was helpful or not helpful, why Mavron was helpful or not helpful, why First Round was helpful or not helpful, and got a really interesting picture. And then you're building the mosaic, right? And people don't have time for that because you've got a portfolio that you've got to manage and committee presentations that you've got to do, and in the fund of funds case, you're fundraising, all this stuff. So people just take shortcuts, and that's why when you take shortcuts, then you default to brand, right? And there are 15 brands today, right? Maybe 20. It's like Congress. Like everybody hates Congress but loves their congressman. So there are people out there who still love like blank ventures. I was going to name names again, but I've already said enough. But anyhow, that's frustrating. So the short answer is like the metric that I like is, and actually, I'll read my next blog post, which I'm writing right now. It'll be up next week. It's about how to build a longitudinal perspective where you're following companies along, you're allowing the LP to follow the companies with you over time, over quarters, right? And you can see the progress and you can see the value add. And I've got a kind of sample slide that I'm going to put in this deck so stay tuned.
How do you think about investing in, with the rise of all these really, really large venture funds? NEA, for example, recently raised $3.1 billion, and it's so difficult to even get a 2x on that. Investing in those versus there's still a lot of the $150 million, $200 million funds.
Yeah, and I'll say I have a very strong bias towards small funds because in 2006 I wrote this blog post called The Arithmetic of Venture Capital, and basically like you can go through, okay, if you have a $400 million fund, that was my whipping boy at the time. If you have a $400 million, which at the time seemed like a big fund, if you have a $400 million fund to return 3 times money, which is kind of what we LPs hope for as a good outcome, you got to return $1.2 billion. But if you only own 10% of those companies, you got to create $12 billion in enterprise value, right? And at the time, we take fees and carry out blah blah. But at the time, or even if you own 20%, you got to create $6 billion in enterprise value. And that's like, you go through this math with GPs and they're like, whoa, we never thought about it that way. And at the time it was like, well, YouTube just sold for, whatever it was, 2.6, and like equal logic for $1.2 billion. Like you have to be in like X number of the big.
Like Bill Coleman, BEA systems.
Yeah, you're right, exactly. Nicely done. But anyhow, so the arithmetic is like really, really challenging, and and there's a rumor out there that kind of LPs have whispered about like what the dynamics were at NEA with respect to, and I don't know if this is true or not. It's like a Kaiser Sose story, like stories that LPs tell each other to kind of scare each other at night. But the rumor was when they had the offer to sell Groupon to Google, and it was at $6 billion, and there was like this big internal fight, like, wait, but how much of that whole fund will we return? And then, the IT team was saying, but that returns 4 times what we've committed, and so we've done our job. And it starts to kind of, now, I don't know if any of that is true at all, but it's intuitively very sensible that debate would take place. And I start to think like, these types of big firms are no longer venture firms, but they're asset managers who invest in growth companies.
I had one question on the slide with Tiger and a bunch of the big guys who are coming in on top of some of these venture deals. How do you think about investing in some of the VC funds as an LP if one of those small micro funds, maybe they're super successful, but all the deals, they end up getting the preferences crammed down at the end? So how do you, I don't know if that's even possible to predict, but how do you think about that?
Yeah, you just stress me out too, you guys. No, the short answer is that you hope that, well, actually, you've opened a little Pandora's box, which I think is a really interesting one, which is I actually have, this is a debate I have with a lot of these micro guys who the classic like late 2000, whatever we're calling that last decade, the aughts, like the classic 2008 micro fund that raised $25 million and bought 3% of 65 each of 65 companies and has no reserves. I'm like, you guys are toast. There's no way you can protect your position. This is why I love first round. Like I'm such a first round shill. I love first round because Josh K says, we're a $40 million seed fund with $140 million of follow-on capital. And now this has led to these, True Ventures just raised a select fund, Data Collective, raised an opportunity fund. All these guys, Foundry, USV, all these guys are raising opportunity funds, I think, to maintain ball control in later rounds. So I think that's kind of become a feature of the landscape, and I think part of it is defensive. Another thing I think is it's not a monotonically bad thing, because I think that Somebody moved my cheese. Like somebody fixed my slide. That's amazing. Sorry, I just had an ADD moment. Look, a squirrel. No, I think one of the opportunities is we're seeing some of the micro guys sell into the later rounds, and I think that's a great risk mitigator, and I think it's an arrow in the quiver. That's my total Pollyanna answer. Like that's the please. I hope you do, but I don't think we've seen how this movie ends yet, and I think the real question is, I actually think there's something structural to what's gone on. Like if you look at what the kind of classic emerging growth small cap market was, that's been completely eviscerated, and there are like 7 reasons for that. That people far smarter than me opine on. But if you believe in Bill, here we are, the home of Bill Sharp. If you believe in what Bill says, that the optimal portfolio is the world wealth portfolio, and that includes intangible things like intellectual capital and stuff, you need to own emerging growth. And the only way to own emerging growth is to own emerging growth companies. And so that's what some of these folks are doing, and that's what some of the folks like NEA are doing. And I think there's a very different, back to the NEA point, not to use them as a whipping boy, but they're offering a very different risk-adjusted return, which actually may be more attractive to certain clientele, right? It's, I don't think they'll ever put up a 25x fund like FRC2 could be, but at the same time, they're not taking the crazy risk that FRC2 took, right? So it's a very different risk-adjusted return optimization. Any more questions?
We'll move on to the challenge portion.
Yes.
First, thank you.
Thank you.
For more, please visit us at stanford.edu.